It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money Show. We are here to try to help you make better financial decisions, and we do that by encouraging you to send us an email. You can do that on our website. Just go to jillonmoney.com, click the Contact Us button, you write your note, and then if we can help you out, sure, we'll be happy to help you out. And if you would like to join us on the program live, well, live-ish, as we like to say, then all you need to do is just check that little box at the end of the form. And I know this is a big weekend. It's Father's Day weekend, Juneteenth on Monday. By the way, markets are closed in case you didn't realize that. But if you have something that's noodling around, get it out of your head and send it to us, because that's how we're going to help you make sense and make the better financial decision, or maybe the next best decision that is ahead of you. We like to start the program off with one of your questions. So here we go. This is a conversation that we are going to have with Elise, who is from Illinois.
Well, I am very confused about the decumulation phase. In a nutshell, this is my final year of work. I'm retiring December 29th, 2023.
Wow.
I've been in my profession for, at that point, 44 years. I've been at the same law firm as a legal secretary for over 41 years. So it's time.
Wow.
Yeah,
wait a minute.
I know.
At the same firm?
The same firm.
Oh my God, that's amazing. People don't do that anymore.
Not really. There's still a few of us left, though, us old dinosaurs.
That's
but my
good.
job has changed so dramatically, so I'm definitely ready for retirement.
Okay, good. That sounds good. How old are you, Elise?
I'm 64 right now.
Any chance that you work at some one of these fancy law firms that has a pension?
No pension.
That's okay. So when you finish up, are there any obligations that we will have to worry about? Do you have any debts that need to be settled up? Do we have to save some money ahead of time to do something for you?
Other than my mortgage, I have no debt.
Okay. So how much is the place that you live? How much is it worth?
I would say $150,000. It's a very small condo.
Okay. And what's the mortgage remaining?
I have about $50,000 left on the mortgage.
Oh, great. And what's the interest rate on that?
3.25%.
Okay, great. In advance of this retirement, have you started to work through how much money you need? Like what is it that you will require to live on?
Well, at the time we got the 401ks, I immediately joined and I immediately got a one-time off financial planner. And of course, back then it was $1 million. And I told them that if I made $800,000 by the time I was 65, I would be happy. And I'm glad to report that I did make over $1 million during the pandemic, but now I have dropped down to around $927,000. So, with the decline in the market, it's down a little bit.
Okay.
So I feel like I'm at a good point. I still consider it a modest retirement.
That's probably because you hang around all those fat cat lawyers.
Yeah, I'm sure that's part of it.
$900,000's a lot of money. But what do you need to live out? Like, what do you earn now?
I would say all in with bonus and whatnot, probably 105.
What do you think you need to live on, though? Like on a monthly basis, you've got your mortgage, you go out to eat, you make some, you do some stuff. What do you think is your monthly nut?
I'm going to say $4,500 a month. That's all in, including real estate taxes, life insurance, car insurance, all that stuff.
Okay. What about Social Security? What's your game plan for Social Security?
I plan to draw down as soon as I retire. Right now at 64, my monthly benefit would be $25.91.
What is it at your full retirement age, which must be 66, 67?
It's 66.8, so 67. It would be $3,176 at full retirement benefit age.
Uh-huh. Do you have any money that's hanging in the bank?
Yes,
you said $927,000.
Yes.
That's the 401k, right?
Right.
Okay.
Between my checking and savings, I have just shy of $30,000.
Any other money that is invested, like in a brokerage account or some old bonds or I bonds, anything like that?
Nope, that's all I got.
Okay, got it. And you mentioned life insurance. Do you have kids? Do you have grandkids? Like, what's the life insurance for?
No, I'm single, no children. I have 2 remaining nieces now, and it's just a small term policy, basically to cover my funeral expenses, to make sure that one of them will take care of their aunt and get her cremated. It's just a small term policy. I think it's only like $25,000.
Okay. All right. Are you planning on saying, when you say decumulation, but you probably don't feel this way, but like you're still young, right? You could live for 30 more years.
Absolutely.
So do you have any inclination to do anything part-time just to keep yourself like active, engaged, or are you just done?
I feel I am done.
Okay. You know the story about Social Security, right? You know that if we make you wait for your, let's say 3 more years, the way that we would kind of manage that is this year you're fine, right? This year. And by the way, are you putting money into retirement right now?
Oh, yeah, absolutely. It's going right now. It's actually going into the Roth portion of my 401k, which I didn't even realize we had because it's way down at the bottom. And I was doing a rebalance a few years back. So there's not very much in the Roth. Most of it's all in tax deferred. I mean, 95% of it.
I'm going to give you something that is maybe going to make you feel weird. I don't think you should put money into retirement anymore.
Okay.
I think you need to bulk up your bank account as much as you can.
Okay. I mean, I did decrease it. I'm not putting as much in as I normally would.
What's the match? Do you get a match at like 6%?
No, we have a wonderful thing called a profit sharing. So we don't have to worry about a match.
Then I would literally stop putting money in as long as you're getting that profit sharing. Great. And I would put all the money in the bank account and I would try to beef up that bank account before retirement, because we have it till December, right? So that's number one. I want more money in there. Here's what I'm thinking. In 2024, you will literally have no income, right?
Correct.
Okay. So essentially what I'm thinking is in 2024, in 2025, and 2026, because I think you're 66.8 and 26. Is that right?
I think so.
I think that's right. So how would you feel if we started pulling some money out of your 401k for the next 3 years? This is scary, but just go with me for a second. So presumably, if we pulled money out of the 401k, let's say that you pulled out, I don't know, 40 grand out of there, 50 grand, maybe 50 grand a year. I'm looking, actually, it's interesting because we may be able to pull money out of that account keep you in the 12% tax bracket. So the bracket at 12% for single is at $44,725. So you'll get your standard deduction. Do you claim standard deduction now, or do you claim? And you do. Okay. So, and by the way, you get an extra standard deduction if you're over age 65. That's just an extra. Yeah, I know that because I looked at my little Ed Slot chart and it told me that. We'll get back to Elise in just a moment. This is the Jill on Money Show. And if you have a financial question or maybe contemplating a big change, just go to our JillOnMoney.com website and click the Contact Us button. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. We are here answering financial questions and also talking to people about the big changes that are going on in their lives. Now, if you think that you're about to take a new job, or you're moving to a different state, or you're thinking about selling some big asset, and you wonder how it's going to impact the rest of your life, well, then you may want to check out my book. It's called The Great Money Reset And this was a book that was inspired by many conversations with you, with listeners of this show and our other two podcasts. And I realized that people really did need some framework for putting these big decisions through the mill, through the financial mill, and making sure that they weren't messing up other aspects of their financial lives by making big changes. So the Great Money Reset, which helps you turn chaos into opportunity, is available wherever you buy books. We have links to all different kinds of booksellers on our website, JillOnMoney.com. Hey, while you're on the website, don't forget, sign up for the free weekly newsletter. It is the perfect way to get prepared for the weekend radio show. Mark puts together all the different stories that have emerged over the week, and some of them you know, some of them give you more context, some you may not know at all. So check it out. That is the free weekly Jill on Money newsletter every single Friday. Just sign up on our website, JillOnMoney.com. Let's get back to Elise. She's on the line from Illinois, and we're talking about how she's going to start pulling money out of her accounts. So essentially, let's say, Mark, does this work? She pulls out, say, 55 grand from her retirement account. She claims her standard deduction. She's now drops into the 12% tax bracket. She pays tax on the money, and she lives on whatever that post-tax amount is. It'd probably be more like 4 grand a month, not 45, but let's just say it's 4-ish. And you do that for 3 years. And then you can claim your higher Social Security benefit at $31.76. Now, what's the benefit of that? The benefit is it's not just that $600 a month, which is a pretty big benefit, but it's a big benefit to do that and delay and get some money out of this account and pay tax at a lower level. Because now we kind of know you're going to have to pull money out of this account over time, and we're just going to pull some of the money out now, pay the tax at the 12% bracket. And that's kind of a great, like a tax arbitrage. You're paying at a lower tax rate, getting the money out, which you know you're going to have to take out eventually anyway. At the worst case, you're taking it out a little bit earlier than you'd like, but you're paying the 12% tax bracket, which, you know, you might actually end up in more like the 22% tax bracket, and tax rates could go up. And so now what happens is, I think that what would be kind of cool would be if you could do this, right? You know, we should talk a little bit about what happens, you know, in advance of that, because essentially what you'd want to do is as you come to the end of the year, you'd want to make sure that in that pre-tax account that you have, you know, 60 grand in a money market account. Like you'd want to make sure the money's in cash so that God forbid there was some market meltdown, the money would be already preserved. And then you just every year, you know, so let's say maybe in the middle of the year, the end of the year, you sell off what you think you're going to need for the following year in cash. It's in the money market and you pull it out in the next year. And that's great. You're done. You're like, that will hopefully help you out. So let's say out of this 900 grand that over the 3 years, we soak up, let's soak up like, even if we took 200 grand out of there, okay? And you're left with 700. You know, when you're looking forward, you don't need as much coming out of that account because you're going to get a higher Social Security benefit. And, you know, if you're thinking about Social Security, it is taxable, of course. You know, if you look at your need of $4,500, now all of a sudden pulling money out of the account is much easier because you don't really need to pull that much out. You're, you know, maybe 2 grand a month, and you can do that. You can definitely do that. I think that that might be a smarter way. I just feel like unless you tell me you have terrible life expectancy in your family or you're not well, I think delaying Social Security, pulling some money out at the 12% bracket could be a smarter and more efficient way for you to manage this decumulation.
What about the notion of Social Security in 10 years? I mean, I'm kind of factoring that 20% loss.
What do you mean? What 20% loss?
Well, they're talking now, you know, what is it, 2033?
Yeah, but once you start, you're going to start pulling money. You claim Social Security in 3 years, right? They're not going to retroactively say whoever's on Social Security, we're cutting your benefits. It's people like Mark that are going to get screwed.
Are you sure? Because I thought it was going to impact people that were withdrawing, were getting benefits.
No way. There would be like an uprising. Since Social Security is the most popular program of like every benefit, that is just not going to happen. From all the people that I speak to, And you might, listen, if you don't feel comfortable with this, I get it. But from my feet on the ground, kind of people who really dive into this, what they say is the system will change for the people who come later. It is not going to change for someone who's already claiming benefits. That would be, again, Mark and all of his Gen X guys and gals. They are the ones who are going to have to swallow lower monthly benefits, or we're all going to pay higher taxes and they're going to keep benefits the same, which is probably the more likely scenario.
I hear so much talk about a bucket system or a pie cake system, and paying off your mortgage. There's no benefit.
You can't pay off your mortgage.
That's what I was hoping you were going to say that. I didn't see any benefit to paying off my mortgage.
No, you need your access to your capital. You need your money. You need your money working for you. So that's not how to do it. But look, I would say that number one, it's close. This is not a slam dunk. You're retiring after 44 years. Ideally, if you really want to, you said, I'm done, I'm toast. Ideally, you'd figure out how to make 15 grand a year for another few years while you're claiming, like waiting to take Social Security. Like you would do a little something. But if you're really toast, then I think you can do this. I don't know if you're going to be able to spend. How much longer do we have to pay off the mortgage?
I think I have 6 or 7 more years left. It was a 15-year fixed.
Okay. So I don't really think you're going to have a problem because then that payment goes away, right? And it's probably not that big a payment anymore. What is the payment on the mortgage?
It's just under 700, 667.
Yeah. So look, I think this can work. I actually think delaying claiming your Social Security, pulling some money out of the pre-tax at the 12% tax bracket makes sense. Living on that money, you can't go crazy in these early years.
I won't be.
You just cannot. If you feel like you're tight, then you get a little part-time income and it will be less tight. But decumulation is really, it's like a Jedi mind game, because I know that we often will get ourselves like, oh my God, it's so hard. And it's really not that hard. Decumulation is basically saying, let me set aside the money I know that I'm going to need within the next year. So you sell something inside of the 401k, which will probably be an IRA rollover at some point. It's sitting in the money market account. You take it out and you use that to spend on. And you don't dribble it out. Like some people say, oh, I like a paycheck every year. I like you having the amount of money in your checking and savings for the year. And you make sure you have the tax, you have them withhold the taxes. And that's it. And you live on that. And wait till you see how you change your habits as soon as that money starts dribbling down towards zero.
Okay, so towards the end of this year, I want to contact Fidelity and move a portion, $50,000 or $40,000, into a money market account.
Yep.
And then next year, I say to Fidelity, send me this $40,000.
Send me 40 G's. That's it.
And then I put it in my savings account.
Yep. And then you start living off that. But between now and then, I want that savings account more. I want you to beef up your savings.
Okay. I mean, I definitely reduced it quite a bit. I'm only putting 6% in. I mean, I actually had quite a bit more in my cash, but I did a massive remodel to my condo.
Oh, how nice for you.
Yeah. I went down to the studs for my kitchen and bath. It was fun.
Oh,
but I survived it all. It was before the pandemic, so I survived all of it.
I think you're okay. If you are thinking, how on earth are you going to learn how to pull money out when you've been putting money in for retirement? Give us a holler, JillOnMoney.com. Click the Contact Us button, and we'll do the rest.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, the program that tries to take the mystery out of your financial life. We do that by encouraging you to ask us questions. Just go to our website, JillOnMoney.com, click the Contact Us button, and we'll do everything else. And it is better when you come on live, even though I know we answer emails from time to time. But you'll see in these conversations, we start to extract other information from you. I hope we're going to do that with Suzanne. She is on the line from the Midwest. Hello, Suzanne. How are you?
Hi there. I'm good. How are you?
Good. What's going on? How can we help you out?
So I have a few questions. My husband and I relocated a few years ago. At that time, he was working civil service job. So he left that job so I could pursue new opportunity. So his job change, I think, set us back a little bit in our retirement savings. So my main question now, we're back on track with a few years, maybe I call it a hiatus from maximizing retirement savings for sure. So just trying to find out the best way to really catch up, stay on track, kind of check in on where we are. I've always said I'd work till 70, but 67 is sounding a little appealing right now. So,
okay, let's do 67 seems like reasonable. Suzanne, how old are you?
I am 56.
And how old is your husband?
He is 50.
50. Good. Excellent. I like that. How much do you guys each earn?
So I'm at about 300 total comp. About 90 of that is bonus. It's pretty standard. He is working now more as a real estate professional, managing a short-term rental property. Mm-hmm. That brings in about $40,000.
Do you guys have any kids?
We have 4 that are all launched.
Oh, my God. 4 kids all launched. Good for you. So let's do some of the numbers. Right now, Suzanne, what is the retirement contribution that you are making?
I am maximizing. So with my catch-up, I am making sure I'm maximizing that the past couple of years.
Okay, so now 30 grand this year will go in. Is your husband making a contribution to a retirement account for himself?
He has not in a couple of years. After we moved, he had a part-time job that kind of ended during the pandemic. So he has not since that job. So it's been a few years.
Okay. So let's go through how much money you've squirreled away. Let's look at his old retirement first. And so he's got some money from previous world. What does his old retirement look like?
So he has a pension. Yeah. That he can begin to draw at 62, and that'll be around $35,000 a year. And he left, still has about $110,000 in a TSP, all traditional.
And no like IRA, Roth IRA for him, right?
No.
Okay, now let's do you. What is in your current 401k?
So current, a little over $200,000 in a 401k. The majority is traditional.
Okay.
Recently switched to Roth, but I want to talk about that. And I put that in a target fund.
Okay. And so 200 in your traditional, mostly traditional 401k, and that's your current. What about your old retirement? Where's that?
So I have an annuity that I bought about 12 years ago. That's part of what I have questions around too. Bought that through MetLife. It's considered an IRA. And it's a variable annuity. It's got a guaranteed minimum income benefit as well. So that will give me $30,000 a year for life starting at 62.
What's the value of it right now?
The value now, the balance been dropping, of course. It's around 170.
Because the annuity at this point, it's an IRA. Inside the IRA is this annuity. You bought it 12 years ago, which probably means the surrender period is up.
Yeah,
and that means that you could potentially take the balance and do whatever you want with it or not. I'm just saying that that's what it would mean for right this second. So, okay, so you've got 200, then 170 in this. What about other money that you have invested?
Got about 30,000 right now in bonds, about 100,000 brokerage in a Vanguard account, like right around 100. That's split in index funds, stock bonds, funds, and about 60, another 60 that's just cash, more emergency fund.
Okay. How about your home? What's that worth?
So we bought a pretty good real estate market, and we have about a $500,000 mortgage, 2.67 interest, and we're at about $1 million in equity.
$1 million value, or it's worth 1.5?
1.5.
Holy smokes. So, all right, now you're going to bang this out for 10 more years or 11 more years. Right now on this $300,000 income, how's the cash flow? What are you doing exactly? Tell us a little bit more about how you're managing that.
The cash flow is really good, especially the past couple of years. We have helped out with the kids a bit, trying to get them fully launched with education and some other things. So now, the past 2 years, definitely cash flow is good. Maximizing the retirement, trying to put about $2,000 a month away in the brokerage. Mm-hmm. Just trying to figure out what to do with the rest.
Do you have more than that? In other words, if you look at you're putting 30 grand into retirement, another $24,000 into the brokerage account, is there more than that? Do you think?
Yeah, there's about $3,000 to $4,000, I think, total to invest monthly on top of the retirement.
Okay, so you're doing two, but then there's another like one or two more that you could potentially do. Yep. Okay. Is there anything else that we should know just about is there, do you feel secure at work? Do you have a feeling of I could do this for 10 more years, no problem? Or is there some concern that maybe you couldn't? Are you in an industry where it's not so great to be a 60-year-old woman, for example?
I don't know if there's any industry where it's great to be a 60-year-old woman.
Amen, sister. I know that feeling. I am right with you.
Very secure, not worried about the job at all.
We'll get back to Suzanne in just a minute. You're listening to Jill on Money. If you've got a financial question, just go to our website, jillonmoney.com, and click the Contact Us button. And don't forget to check out our subscription service, Jill on Money Live. Access to quarterly webinars and bonus content. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. Let's get back to Suzanne from the Midwest. She wants to know, do they need to catch up because they started too late?
We also have good Social Security. We went and did another check on where our Social Security would be at, and we'll be in good shape.
So what were those numbers at 67?
67, I'll be at 36, and husband will be at 25.90.
And I mean, theoretically, if we look at, the going forward at 67, just use today's dollars. What do you think you actually what's your monthly nut? What do you really think you need to live on? And be generous. I don't want you to, kill yourself here.
Yeah, let's say 12,000.
12,000 a month. Okay. Okay. So you're going to have, 36, 25.90. Those are your Social Security. His pension of 35 grand a year, $3,000 a month, right? Maybe, we're not saying this is definite because I'm not sure about this annuity. I really need someone to look at this thing because those things are beasts, meaning that I really have to see is it really worth it to annuitize it, or is it worth it to get the 170 grand out and start to be more affirmatively aggressive with it in terms of your own brokerage. I'd like a little more information on that. Based on my quick back of the envelope is you're going to have $9,200 a month coming in when you're 67 years old. So that means that we certainly need you to beef up your savings and your money in your retirement accounts. But if you're willing to work for 10 more years, I don't think that's going to be a problem. We need you to get, a bunch of money. And then I guess the other question is, if you have this house that has so much equity, is it likely you're going to keep the house, or is it more likely you're going to be I'm out of here? Because you said you're relocated. Maybe you don't want a Midwest winter. I don't know. But what do you think is going to happen with the house?
I think we're going to stay. I mean, we thought we'd probably want to be out of here, but we're really enjoying it. So I think we'll stay.
Okay, that's fine. that seems, I don't want you to move if you don't have to. I think you're actually in great shape. Putting the money into the Roth for you, 30 grand into Roth, fantastic. Okay. That would be a great thing for you. It's going to hurt you tax wise. Are you okay with that?
Yep. Yeah. Already took that hit this year.
I know. Okay. So that's good. And then instead of putting $2,000 into your brokerage a month, put $3,000 or $3,500 and call it a day. And if you get a huge bonus, just plug that money in there. Are you working with a financial advisor?
I'm not. Just a Vanguard with a
the personal
advisor.
Service person?
Yeah.
I'd love to have someone look at this annuity. I would show that annuity and say, is it worth it for me to keep this? Is it really worth it? There is every ability for you to take the balance of this account, move it into an IRA rollover, and then roll it into your retirement account and just have that's all of your money that hasn't been taxed yet. So there's a possibility you could do that. I don't want to screw this up. Annuities are so funky because generally they kind of suck in terms of fees, especially from 12 years ago. But there's a sunk cost. You already had the money invested and you actually paid the price. It may be that this could be one of those instances where you're like, well, now if I don't futz around with it, it could be good for another 10 years. I just need someone to take a look at that and to do an analysis. And if you want someone to do a deeper dive, you can always hire a fee-only planner by the hour and say, can you rip apart this annuity and tell me the best thing to do with it? And that is something I would pay money for that. I would pay an hourly rate. If someone said, it'll take me 2 hours to do the research, I would gladly pay someone $500 to do that and do that research for you and know that they're not trying to, hose you and get you to buy something else.
That makes sense.
And then you've got the brokerage account. You're building that up. I think it'd be really cool for you to, again, you're going to be putting in so much money. You're going to put 40 grand a year into your brokerage account. That's going to beef up. And then you're going to limit the amount of money that you have to take out later at that, age 75. And we probably could do some planning work. Again, who knows what the tax rates are going to be, but maybe between, age 67 and 75, we maybe do stuff. Maybe you still like working and you're like, I'm going to work for 2 more years. Or maybe you're like, yeah, you know what? I'm out of here. I'm done. But you're going to have a lot of options. So I think this is a good game plan and I feel comfortable with it. And I think it's weird. It's to some extent, you're like, oh my God, we're catching up. But you've done a very good job. And your husband's pension is kind of a real security blanket for you at a time in your life when you're going to be really psyched. I mean, there's a 6-year time difference, age difference. So that means when he's starting to take his pension is just when you need it, when you're like, okay, I'm done working.
Yeah.
So I think it works. I think it works. Now, you guys have your estate documents done for these 4 kids? Everyone okay? Okay, good. If you, like Suzanne, want to know whether you're on track or not, give us a holler. Just go to JillOnMoney.com, click the Contact Us button, and complete the form. Now, if you'd like to join us and have a conversation with us, then you'll need to check the little box at the bottom of the form that says, yes, you would come on the air with us. We'd love that. Jill on Money. We'll be right back. You're back. It's Jill on Money, and we are here answering financial questions. Let's do an email. This is from John, who says, I've heard you ask many of the listeners whether or not they've had an estate plan. I always thought that estate planning is for the very rich. I also vaguely recall some tax advantages of having an estate, but again, mostly for the rich. Would you mind sharing with your listeners what estate planning is, who it's for, how one can do it, and how it's different from a will? John, thank you so much for asking this question. I know I harp on this, and you're right. Sometimes I just launch into it without giving a broader description. So estate planning is really the idea of just thinking about what are your last wishes? How do you want your money to be distributed? Who's going to take care of your minor children? And who's going to make decisions for you if you cannot make decisions on your own behalf? The core documents of an estate plan are threefold. Number one is a will. A will ensures that your assets are passed to your designated beneficiaries in accordance with your wishes. Now, if you've got minor children, that's where you usually would name a guardian from them. And that's, of course, where many people get into big fights with their spouses. Then there are two other documents that are wildly important, maybe more important in some respects than the will itself. The first is called a healthcare proxy. You assign the right for someone else to make healthcare decisions on your behalf if you are not able to do so yourself. This is not just end-of-life care. This can be a lot of different things. People who understand what your wishes are because you've articulated those wishes to those people. And then there's another document called a durable power of attorney. This assigns somebody the right to act in your interest if you can't, but for a business matter. This can run the gambit from signing papers and enrolling in retirement benefits to a real estate transaction, and it doesn't just have to happen at the end of life. It can happen at any time. So those are the core documents. You need an estate planning attorney to draft them if you have any sort of complications. Otherwise, you can check out some of the online services. And in terms of the ability to reduce taxes, that's vitally important if you have an estate that's worth $12.92 million or more. So maybe you don't have to ask about that, but I'm happy to answer that if you've got follow-up questions. This is the Jill on Money Show. We've got a whole nother hour ahead. Stay tuned. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's hour number 2 of the Jill on Money Show, and we are here answering your financial questions. If you've got one, just go to jillonmoney.com, click the Contact Us button, and then write your note. If you want to come on the air live, you got to check that box. That's what Mary did. She's on the line from Portland, Oregon. Hello, Mary. How are you?
Hi, how are you, Jill?
Great. What's going on?
Well, I relocated to the West Coast. I'm going to be 65 in September. I wanted to talk to you about what I have invested and my future.
Oh, my God, that's and my future.
My future.
Okay, very good. So tell us what is going on. How can we help?
So I relocated. I sold my house and purchased a condo. The value is about $450,000, and I have no mortgage on that. Mm-hmm. I have my savings is about $600,000, $430 in an IRA, $145 in mutual funds and stocks.
Meaning non-retirement. The $145
yes,
non-retirement. So that's like brokerage, okay?
Right. And then about $25,000 in cash.
Okay.
So that's what I have now. I don't work. I babysit for my little granddaughter. And so my children, they'll put gas in my car, they'll get groceries, etc. So they give me little perks here and there.
Okay. I like a perk from my kid.
Yeah, payback after paying for their college.
You
want to know where your money went all your life. It's
yeah. So is what they are providing for you allowing you to just live? Is it enough, or are you dipping into some of your savings?
Yeah. So I am drawing $4,000 a month from my mutual funds, my non-IRA.
Okay.
And that's, okay. So my debt is, I have a car loan and I have a balance of $12,000.
What's the interest rate on the car loan?
I think it's 2%, under
It's
2,
cheap.
very low,
Okay.
yeah. And then I had a business, and during COVID, I got a $20,000 small business COVID loan, which is to pay off in 30 years, and that's $20,000. So that's my only debt. And then I applied to collect Social Security on my ex-husband. And I'm in the process of that. And it's very interesting. They won't tell you the numbers.
Yeah.
They tell you it's more than what you would get.
Yeah. That's so, I know I've heard that like, because I guess it's privacy, right?
It's privacy.
Okay.
And of course I shredded my divorce decree 20 years ago.
You might need that.
Well, yeah. Everybody out there, do not do that.
Don't do that.
But I finally got it. And I would say within weeks, I will see some kind of deposit, hopefully, into my account. Right now, I think at 50% of his, I would get about $1,600 a month.
Okay, but that'll help. So that we can immediately reduce the amount of money that you're pulling from. As soon as you get that, you can go back to, say, I don't know, we can go at least 20, 2,500, 2,000 a month, right? Okay. I mean, you're pulling a bunch of money out of this account. I'm a little concerned that you could run out of money. So any ideas about, like, with all the nice help from your kids, are they willing to help you more significantly? It is possible that, you're just not going to have enough money to float your needs. I mean, if you're pulling $4,000 a month out after tax, are you really spending, like, say, $3,500 a month? Is that what you think your spend is?
I can definitely clean it up. And of course, in my Cinderella mind, I think that the stock market's going to go up, and all the money that I pulled out the past year, I'll see it next year. So,
I mean, that's not a great. I mean, hoping is lovely, but just to be clear, if you have 600,000. And, right now, and I'll just deal with that 145, you're absolutely on track to deplete that 145, right? Maybe what would be more important is to kind of sharpen your pencil and see, like, what do I really need to spend money on?
Okay.
Right? It seems to me that, 50 grand or a year. I mean, the thing is also, when you take money out of the retirement side, you have to pay tax on it. So it feels to me, and looking at this situation, that, you could deplete these accounts within 10, 12 years.
Right.
And
but then I think in 10, 12 years, I might downsize because, of course, my other children on the East Coast can't wait to have children so I can come back and babysit there.
I mean, I don't know. Mark, what do you think?
It's dangerous. It's a dangerous situation. I mean, Social Security will obviously help. Right now, you're pulling way too much out.
Should I get a part-time?
Yeah. Like, if you could get a part-time job, that would be great. Or your kid's got to cough up more money and help you out. Those are the two choices.
Okay.
I mean, and I would say on $600,000, okay, if you just want to give, like, yourself a little bit of breathing room to know, like, what can I pull out of that $600,000 so that I won't run out of money? It's like, it's like 15 grand a year, 20 grand a year, not 50 grand a year.
That's my project, to clean up.
Right. And if you said to me, actually, what I'm going to do is I'm going to sell the condo that I bought. How much did you pay for this condo, by the way?
I paid $440.
And what's it worth now, you said?
I'm going to hope $450.
Okay. So like, if you said to me, well, I have an extra $450 in cash, I'm moving in with my kids, that would be a humongous help for you. Humongous.
Okay. And I never planned to, but I'm in a city, so that's what I had to do. I never planned to spend that much on a condo.
Yeah, I mean, like, as far as I'm concerned, if you had that money, then we're talking. Because now, if that money was, if you had $1 million, okay, then we're talking about pulling out 30, 35 grand. And that gives you a lot more breathing room It really does. And you'll have lower expenses. So I think it's worth considering whether or not you can make that work.
Right. Should I rent?
Potentially, but we'd have to see like what the numbers are. But having access to that money would be huge.
Okay.
So it would really mean, in your life to really say, okay, this is what it costs to have this condo. These are the fees. This is this. And then tell me what would rent be for you in the right area. Or if you say to me, hey, you know what? I'm really going to move back to the East Coast. And I know I'm going to move in with my kids' big house. They live in blankety blank. But I think that you're doing a very nice thing for your children, but you're doing so at your expense. Yeah, a little bit at your own. I mean, I know it makes you feel good, right? You probably love babysitting and you do this, but there's risk. And I would not be, if you're my friend, I would say, this is not making me feel comfortable because you retired, you had money, but you don't have enough money to just never work again. If you'd like to join us on the air, all you need to do is go to JillOnMoney.com, click the Contact Us button. We'll do the rest. Don't forget to check the box that says you want to come on the air live. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here answering financial questions. Let's bang out a few emails. This one is from Paul, who wants to save for granddaughter. And the question is, are government savings bonds the safest way to invest for a soon-to-be-born granddaughter? That's a very interesting question because safest is different than maybe most efficient. So when you think about using bonds for higher education, that is a way that you can buy a bond, and usually when you buy a bond, there's a tax event when you redeem it. But if you use it for higher education, you don't have to pay the tax due on that. You file an IRS form and you submit it with your tax returns. That said, it's not like my favorite thing. I got to be honest with you, because I know that if you want safety, there are other ways to be safe and use the 529 account. And I think now that the rules changed on 529 accounts, whereby if you open, this is part of the Secure Act 2.0. If you open a 529 plan, you fund it. And in this case, maybe you don't want to have very risky investments. You can choose safe choices in there. You open that account, as long as it's open for 15 years, you'll have a ability to move $35,000 into your beneficiary's Roth IRA later in life if you don't need the money. So it used to be that people would say, I'm going to buy a savings bond because what if my kid doesn't go to school? Now it's even better, which is if your kid doesn't go to school, you can use up to $35,000 and make that available. So check that out. I think that will be good for you. Okay? Next up, this is Karen, who says, I am 70 years old. I'm in good health. I retired in 2015 from the federal government with a mortgage balance of $270,000. I don't have any other meaningful bills. I have an annual pension of just about $55,000 plus Social Security of $36,000. Karen is currently taking $18,000 from her 401k. So those are all the annual figures that she has before taxes and deductions. She said, my 401k balance is $260,000 and I'm earning about 3.4%. So it's in an income fund. So the question, should I pay off my mortgage with my 401k or keep as is using my mortgage interest as part of my tax deductions? Karen, the big reason that we would not suggest that you use that money to pay off your mortgage is that, I know the bill goes away, but so too does your access to the money. your liquidity is reduced, meaning you could potentially, I guess, get a home equity loan or another mortgage later down the road if you needed it. But I'd rather you keep that money on hand. You know, at your age, at anyone's age, it's just so nice to know that you could have that. And to me, that liquidity is so much better than maybe the sort of weight of carrying around what you think is like, oh no, I hate that mortgage. It's much more important to have the liquidity. Okay, this is from Michelle, whose husband is 75 years old and has Parkinson's disease. Oh, and he's also under treatment for cancer. Oh, poor Michelle. He's a veteran. He is disabled. He receives $4,800 a month of a disability payment, $1,700 of Social Security, and I get Social Security of $700 a month. I'm 74. We have a tax exemption for our school and property taxes due to his disability. Our mortgage is paid off. We have a little under $300,000 in savings. We have no retirement accounts. I'm in pretty good health. This is a terrible situation. My goodness, I'm so sorry. When he passes away, the disability payment will also go away. Oh. So then I may be eligible for a $1,500 a month survivor pension. So that would mean that she would have $1,500 a month plus the $700, or what happens then? Yeah, I think it's weird. She gets Social Security, but wouldn't she be better off, Mark, getting half of his? It looks like her Social Security benefit is lower than half of his. So number one, we'll have to check in on that, okay? The other part of this is that she'll stay in the house with the tax abatement. So she said, our savings are in a low interest savings account. I'm planning to move them to a higher interest account. The house is not in good condition. Should I use money from our savings account towards renovating the house? I assume it will cost at least $100,000, if not more. Or leave the house in disrepair and hang on to the savings. Oh, gosh. This is a terrible situation. So here's what I think has to happen here. She does say, by the way, they are just bankrolling the disability payment, which is good because that will add. So you should move the $300,000 and move that into higher interest accounts. Like the previous question, access to your money is really important. So I would be careful not to do this house renovation. Maybe for right now, while your husband is still alive, the house is fine and you can stay in it. But you didn't mention how much the house is worth. And I'm wondering whether that maybe in the future you may have to sell this house or do a reverse mortgage and get access to some of the money, because I'm not clear that you're really going to be able to keep that house intact. And I really don't want you to use your access to that big fat $300,000 cash and plunk it down on a house renovation. Again, I'm so sorry about the situation. It sounds so stressful just reading it. And so I hate to boil it down to just the bottom line numbers. So you can give us a holler if you want to come talk to us on the air about this, because I know this is a terrible, terrible situation. Okay, Mike is 75 years old, and he's single. He's got no debt. He's got some monthly bills. He owns his house and a car. He's got 34 grand in an IRA, 250 grand in the bank. Social Security and a small monthly pension pays for everything that I need and also allows me to save $5,000 a year. Oh my gosh. I had the IRA in a Vanguard mutual fund account. I just switched to JP Morgan to oversee it because I lost money. I'm thinking of purchasing a new car for $30,000. Would it be advisable to just cash the IRA instead of using the other money? You know what? I would cash that IRA out. The thing is, it's going to add to your tax liability. Maybe it pops you up into the 24% bracket. Hopefully not. If it keeps you in 22%, then sure. I'd get rid of it. I'd cash it out. I'd buy your car, and I'd move on. It's very rare that I say people should buy their buy their car with their IRA assets. But given this guy's situation, I think it's fine. Hi, Jill and Mark. This is from Rosanna. I'm sort of in the market for a new vehicle. I'm looking into EVs, which would save us a lot in gas. We live in a rural area, and the Subaru that they own, a Forester with 140,000 miles, takes premium fuel. Okay, EVs are more expensive. I own the Subaru outright. I have for about 5 years, and it's been so nice not having a car payment. According to calculators that I've used online, I would need to drive a new EV for 5 years to break even on the purchase price compared to similar gas-powered vehicles. The dealership's given me a good price for my trade-in considering the miles, so I'm wondering, should I take advantage of that? If I drive it a few more years, I won't have any trade-in value at all. But the prices of EVs might also come down. And the EV she's considering is not eligible for the $7,500 tax credit. It's probably because she's not looking at a U.S.-made car. But the car company is offering rebates now. So, Mark, should she buy an EV or keep driving the gas guzzler?
My vote would be keep driving what you got.
Me too. I'm into do it. Just drive it into the ground. The EV market is going to get better and better. I say stay with what you got. And also, this is my bet also with just in general with EVs. I'm kind of betting that the technology gets better and better. The charging networks get better and better. So I'm feeling like, you know what? I'm going to drive mine into the ground. So join me, Rosie, and we'll be there together. If you'd like to ask us a question, just go to JillOnMoney.com, click the Contact Us button, and we'll get your note. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we're here answering financial questions. And if you've got one, you can go to our website, JillOnMoney.com. And while you're there, you can check out all the great content that is there, the blogs, the videos, the resources, all there for you. If you've got a question, that's your magic website as well. Just click the Contact Us button, write us your note, and if you want to come on the air, just check that box. Let's get to an email from Bianca. When you and Mark talk about estate documents, what are those exact documents? I understand the need for a will, a power of attorney, and advance healthcare directive, but does everyone need a revocable trust? Bianca gave us a link to an article on nolo.com about a living trust. She says, it seems that we fit the case of not needing a living trust at this moment. So let's find out about Bianca. She's 40, husband's 45. Their wishes are simple. We plan on leaving everything to each other if one of us passes before the other. And when we both pass, everything goes to my stepson. He's currently 22, no other children. We are of those typical means, meaning we've got about a current balance of $450,000 for both of us in retirement accounts and emergency funds, excluding the house value of $300,000. We don't own a small business. We're W-2 workers. Am I missing something? No, you don't need that. A revocable trust, a changeable trust, is very good for conveying assets when there is a complication, a small business, a bust out kid, an obligation to someone else. You don't need it. I mean, especially when you have mostly retirement accounts. And as Mark and I have been talking about this more and more, check with your bank. Check if you happen to have a brokerage account. There are many people now who have the ability to actually have a transfer on death account. And that is wonderful for non-retirement assets to be able to pass more seamlessly to your heirs. So I would encourage everyone to talk to their local bank, wherever they're keeping their money, or go online and see if a transfer on death is option for your non-retirement accounts. This is from Kevin, who says, thank you for publishing your articles. I read your column in the Chicago Tribune. Okay, question. Should the U.S. Congress not pass a bill to raise the debt limit and default occurs, how would it how would it affect individuals holding T-bills and T-bonds maturing between July and December of 23? Will interest not be paid? Delayed payments? Lower interest paid? Kevin, great question. The answer to the question is that there are other measures that the government would likely take before they stop paying interest on bills and bonds, because that would essentially be a technical default, and it would be a cluster you-know-what for the government. So what's likely to happen before that time is furloughs, where they would hold back. They might say to people like, don't come into work. They would basically say to people who are essential, you're going to work, but we're not paying you. But there's I think there's a whole host of other measures that would occur before bills or bonds would be impacted. And I don't think that there's really any plan for that. I'm sure that the Treasury has a break the glass plan. But, what you really need to know is that if the situation were to escalate to such a point where they are not paying you your interest, my guess is that it would be a short-lived experience. The markets would get rocked. Congress would get spooked. They'd come back. They'd make the deal. And whatever interest you're owed would be paid eventually. I think that's probably a pretty good bet. Bruce writes, does it make sense to sell some brokerage bond mutual funds that are down around 5% for the past year and put the proceeds in a 1-year 5% CD? I could recoup my losses, eliminate some market risk exposure in these uncertain times. When the market gets back to normal and savings rates drop, I can jump back into the market. I'm 72 and retired. Bruce, I bet that you never would imagine that many people have thought that very same thing. The problem with your philosophy is, I don't know when the market gets back to normal. I don't know what's going to happen. And what's more likely to occur is that by selling out of those bond mutual funds that are down, right, you lock in the loss. And as they come back, as prices start to increase, you are not enjoying the actual ride back up. You're stuck in your CD. And then at that moment, when the CDs, after they're maturing, what ends up happening is you're stuck having to buy back into the bond mutual fund after they've already recovered a lot of those losses. That said, is there some money in there that you just say, I'm never putting back in the bond market? Then you could use CDs, but just know that there's interest rate risk in that. What you're going to say is, I'll put the money in for 5% now, but in a year, the rate might be 3%. And so what I think makes more sense is to really look at the amount of risk you have in the overall portfolio, determine what you want in or out of those mutual funds, and, stick to your game plan. Try not to time the market, because that's exactly what you're asking. When you write a statement like this, and everyone listening, I know we've all thought it, when it gets back to normal, I don't know when that when is. It's so difficult to project. This last email is from Teresa, who wants to know, how do you cancel life insurance? Okay. So here's the thing. Before you cancel an insurance policy, there are some questions that are always worth asking the insurance company. Number one, is there a tax event if I cancel this insurance policy? That would be the type of insurance that has a death benefit. I'm not saying you shouldn't get rid of the policy, because of the tax event. It's just that I want to know what it is. When you cancel an insurance policy that has cash value, the determination as to whether or not you pay taxes is based on how much money you put into the policy and what it's worth. If you put money into the policy, let's say you put $15,000 into the policy, the cash value is $30,000. The difference between what you put in, the cost basis, and the cash value that you get out, the $30,000, that $15,000 is taxed as ordinary income. Okay, so before you cancel any policies, Teresa, do me a favor, find out whether or not you have any tax hit that's coming. And if you do, then just make sure you set aside the right amount of money. And before you give up that policy, just make sure you really don't need it, because it's tough to get it when you do need it. Okay? You're listening to Jill on Money. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. Let's get to another email. This one is from Tech Mama, who is at a crossroads, wants to know if she can retire with her tech severance. Okay. My partner and I are in our mid-40s. He's a government worker. Ding, 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 pension, making $115,000. We're on his medical insurance. He plans to retire next fall when our kiddo goes to college. I make, you ready for this? Whoa. Cue the hate mail. $390,000 combined salary and bonus with $1 million of restricted stock units that vest monthly over 4 years. It averages, you ready? 20 to 24 grand a month based on the stock price. I don't sell upon vesting. So she doesn't sell it. She just holds the stock, and she acknowledges I probably should. The big change is that as of April 1, my income is zero because I have been part of the recent tech layoffs. I will receive $120,000 in cash, about $125,000 of restricted stock units on an accelerated vest. Okay, here we go. $314,000 in restricted stock units, $419,000 in stocks, $125,000 in a pension for the partner, $210,000 in partner's deferred comp with a mix of index funds, $372,000 in 401k and Roth IRA, $300,000 in emergency with no interest. Come on now. All right, she already says I'm moving $200,000 of it. $45,000 in an HSA, $25,000 in 529. Kid will be on a scholarship, needs about $20,000 to $30,000 a year additional. They're going to take loans and pay it all off once she graduates. Wait a minute. Stop it, Mark. $20,000 in crypto, but here's the next. This is what Mark knew was going to get me. You ready for this, gang? Tech Mama has 15 single family homes worth $1.5 million. 15 homes? They cash flow $5,000 to $6,000 a month. They're going to 1031 exchange 2 of the 3 of the poor performers. They're going to reinvest in better cash flowing properties. We've paid most of them off using my vested RSUs and annual bonuses.
How in the world? 15 homes, only 1.5?
I don't know. They're really not, they must not be in a very nice area. They rent in a high cost of living area. They don't own a primary home, but they'd like to buy a house in a low cost area in the next 3 years. Well, maybe you should just move into one of your houses. No credit card debt. $20,000 a month. I know it's a lot. We need to cut down. Maybe you don't need to cut down. Is it wishful thinking to consider retiring instead of returning to tech or doing something else that might pay less but give me more freedom? How can we put the severance and the $300,000 to better use to help us achieve financial independence in the next year? All right. So they're in their mid-40s. So what's the deal with him? He's going to retire next fall. Do they want to be in their mid-40s and be done with $3.3 million bucks?
On $20,000 a month? Sounds like it.
No way. Well, okay. Let's do something fun. Let's say that they sell every single property, which, by the way, would probably be a killer tax event. But let's just say they netted $1 million bucks from selling their property. So now they have $4.3 million. Right? $4.3 million. They got to spend some of this money because the kid is going to college. I don't think you can do it. Here's what I think. My guess is if you both were to get some job, which is kind of like a more chill job, maybe each of you would get it. And so instead of making $500,000 a year, if you could make 200 and basically, pull a little bit of money out of but between the two of you, then I think you could do it. But I think they're short. I'm intrigued because, look, if you keep the real estate, right? Let's just pretend you've got $5,000 a month cash flow right there. Okay, so now we need to come up with $15,000. Again, I am not telling you to pull back on your spending. Let's be realistic. Let's see where you are. So you've got, of your 20, you got 5 covered. So now we need $15,000 a month. And so if you guys could both together make a couple $100,000, you get a large portion of the way there. And I don't think that that's the worst thing in the world. Like, I mean, if you both together, if you made half as much post-tax, you could support your 20 grand a month. And I would certainly do that at least until your kid's out of college. I really would. Then I think we have other decisions to make. And I'd be interested to know, like, are we really keeping this real estate for a long time? I don't know what's going to happen. But in the big picture, I think you have at least 5 years where you both have to work, but you only would have to make half as much as you're making now. The other piece of this, you have a lot of risk in here. You got all the money in the RSUs, which you're not selling, a bunch of money in your company stock. Like, all this needs to be diversified. You should have a mix of index funds in all of your investments. If you want to keep your 200 in high yield savings account, that's fine. Get the other 100 to work. Maybe you just need 150, but you need a lot of money in cash because I don't know where you're going to get your job and what's going to happen. So, I mean, I think they're a little bit early to do this, Mark. Do you agree?
Based on what we're reading, yes. And I'm also wondering, like, if he retires next year, do they keep health insurance or do they have to pay for it?
I'm going to assume they keep it because she said federal government. I'm hoping. If you have a question, just go to our website, JillOnMoney.com, click the Contact Us button, and we'll get your note. We'll be right back. You're back. It's Jill on Money. And before we conclude the program, let's get to an email. This is from Joyce, who writes, my son is engaged and he is concerned about protecting his IRAs and 401k investments should the marriage go awry. Is it true that a spouse can claim half of these accounts in a divorce? Is a prenup necessary to protect his investments? Well, this is quite an interesting question, by the way, because it is wedding season, and I've been thinking a lot about marriage and money and who does what, but this is a much more specific question. First of all, I think that the bigger issue is, does there exist some large disparity between your son and his soon-to-be bride in terms of their overall wealth? If that's the case, that can be one of those circumstances wherein a prenup could actually be important. I would actually encourage him to talk to a matrimonial lawyer if this is something that's on his mind, because it is true that oftentimes a retirement account can get brought into the marital assets, and that can be an asset that would be used to divide in a divorce. Many states, it's what you bring in, you take out, but there are community property states, and there's all sorts of quirks in the law. So I think if he's concerned about it, he should consult with an attorney, maybe not bring it up to his intended just yet, maybe get some information first. But again, I'm not anti-prenup. I just want to make sure that it's actually necessary. Perhaps in the state where he resides, it's a no-brainer and you don't have to worry about it. So I hope that helps. Well, that's it. That's the program. We are so delighted that you join us every single week. All of our content lives on our website, JillOnMoney.com. There you can buy the book, The Great Money Reset. You can subscribe to our new service, Jill on Money Live. That's where you have access to quarterly live webinars and lots of bonus interviews that we post up there. It's really been great. You can sign up for the free weekly newsletter, and you can always click that Contact Us button. That's how you get in touch with us. Our music is composed by Joel Goodman. Karen Kranick is our web queen. Mark Talercio is our executive producer. Lift someone up. Change your work, change your wealth, change your life. Thanks for listening. We'll talk to you next week.